and it looks like they're not only struggling when it comes to growth in the US, their home market, but also those global growth figures starting to look disappointing. Let's have a look at how we are expected to open when we do in just 2.5 hours here, up 0.4%, up to 5,202 points. Again, suggesting that it'll come in large part due to what happens in that energy space and the material space. Now, for more to aim across to the Australian dollar, sitting there at 78 US cents. That's a strong result, and you would think disappointing. Glenn Stevens, who's currently keeping an eye on things over in New York, will go into his comments throughout this half hour. Now, for more on what to expect in today's trades, James Ordus joining us now from Shaw and Partners in Sydney. James, thanks so much for joining us. Let's maybe start with that Australian dollar, because really that's probably going to be in large part what's going to be driving the results on our markets today. Glenn Stevens over there in New York seemingly schooling central bankers on how he thinks this should play out, suggesting they need to maybe step back from the brink, thinking about looking at helicopter drops of money. But you would think he is starting to get concerned about that Australian dollar. Are we going to go over that US 80-cent handle?
Well, it seems like momentum's definitely to the upside, taking the Aussie towards that 80 handle. And as we know, Glenn Stevens wouldn't be happy about that, and the RBA wouldn't be happy about that. But there's little that they can do about that. They could drop interest rates. How shorter-term effect that might have on bringing the currency down would be debatable. It'd have to be a wait-and-see kind of scenario. The RBA's got a lot of firepower in terms of their ability to lower rates to stimulate the economy should things go into a more dire pattern than where they currently are. So, in some ways, they could be given credit for having held the rates as high as they are and giving them that room to move should things transpire that they do need to move to stimulate the economy. But I would suggest that Glenn Stevens would much rather it be significantly lower. It was just a short time ago that we went barrelling up through 74. Now to hit the 78 level, and 78.26 it hit a couple of hours ago. The momentum seems to want to carry it towards that 80-odd cent level. And it's hard to stand in the road of this thing at the moment. Not sure where all the buying's coming from. Is it offshore buyers of our fixed income? It's going to be a conglomeration of different things. Obviously, the push up in iron ore and oil is going to have a significant amount to do with the Australian dollar rallying. Where it ends, we don't know. Maybe 78.50 could be some kind of a resistance level for it on the day, but if we get a break to the upside through there, then momentum could carry it a bit higher.
James, let's break this down. How do you play this? If you are thinking that the pressure is the upside, the Australian dollar is looking potentially going over the 80-cent US level, then how do you play this out? Do you look at potentially maybe downing some of your exposure to the US? Obviously, that was a big play a couple of years ago to try and get those stocks that were exposed to US earnings, because then if the currency fell, this is the opposite situation. Do you look at that? Do you look at maybe working out, tinkering with your commodity spaces, those who have to pay out their expenses in Australian dollars? Does that start to look problematic? How would you be suggesting a restructuring your portfolio?
Well, as you suggested, when the Australian dollar, we've got to those lofty levels of 110 to only come back down and trade sub 70 as recently as the last several months. That type of a move really helped Australian investors into the offshore markets, and obviously that also caused a tailwind for the big Australian exporters into the foreign markets, particularly into the US. And at the moment, what we're seeing is a little bit of headwind. But if you look at it on a relative basis, where the Australian dollar was, where it's gone to on the downside, and where it's popped to at the current levels, it's still not knocking out your rates of return that you would have been receiving as a premium, including the currency effect over the last couple of years. So I wouldn't say that it would be, batten down the hatches and exit all foreign securities and repatriate to Australian dollar for fear that it's going to continue to rally harder. I think that you could still get the equity premium returns in the US markets and in the offshore markets as well that would justify even holding a position without trying to hedge it.
Let's not hit the panic button just yet, hey? Let's look at the iron ore place, the commodities plays generally. We've had iron ore bounce overnight, 4%, means 8% over 2 sessions. It's a very healthy bounce, even with a bounce in the Australian dollar. The Australian materials companies look like they're doing pretty well. Is this giving you pause for thought? Do you think maybe they're starting to look more attractive, or have they run too hard?
Well, it's a really hard call. I mean, we saw the January low of 144 on Fortescue as an example, and for it to push the 330 odd level yesterday in Australia. The momentum for the stock to have moved up that magnitude is incredible, and obviously there's balance sheet issues with Fortescue that they're addressing, which is part of the reason that the stock's rallying. It just hasn't been the the underlying commodity iron ore, which has moved significantly, which has taken that stock up. So, the analysts will have a look at the likes of BHP, Rio and Fortescue, obviously, and a lot of the smaller players and try and, price in the newer iron ore levels that we've seen so far this year. Now, iron ore at the moment trading where it's at is trading at levels which is far in excess of what all but any of the most bullish analysts had positioned it for, and we're only 1 quarter into the year, so well may it be that we see significantly lower levels trade for iron ore through the back end of the year, but at the moment it would have to significantly trade lower to be at the average of what some of the behemoth wirehouses out of the US, and take for example Goldman Sachs are positing that, and Citigroup as well, that the iron ore should be trading at over on an average through 2016. So I'm really not sure how much we would pull back. I mean, we got that pullback from that spike that we saw, that massive spike where we saw a near 19% move in 7th of March, I think it was, overnight in the iron ore index, and many commentators were saying at that time, this is unsustainable, this can't play out. Now, we did get some retracement, obviously, but now, at the moment, where we're parked 1.4% below what that 7th of March high was. So, it did certainly come back. There would have been some profit taking in the iron ore index itself, but it certainly, rallied back up strongly from there. And similar to the moves that we're seeing with oil, the oil complex, we all came into this week thinking that the oil complex, WTI particularly, would get given and potentially trade to the mid-30s, and it did. I mean, at 37 or so, went close, but it now would pop back up over the 40 level, so we've got a 40 handle on both WTI and Brent, so they're really strong. They're going to carry over into the Australian material space, and we wouldn't have thought so probably 6 weeks ago, but wouldn't surprise me if this week we even see BHP with a 20 in front of it.
Yeah, James, I thought some of the most interesting results that we've seen overnight from the US session was in the healthcare space. Johnson & Johnson beating estimates up 1.3%, and Managed Health maintained issuer United Group also doing well. I'm just wondering, is there lessons there for the Australian market? Obviously, America is a similar market in many ways, including their demographics. Do the health stocks in Australia start to look attractive to you, that demographic play, the issue of government support, and obviously rising health costs generally? Does that start to make the health sector look interesting?
Carrington, they're really good questions. Unfortunately, mate, they're probably not the best positioned towards me. I'm not an Australian stock-specific expert on any by any means, and so on a systemic basis, you would think that the move in the US healthcare stocks would translate, and then on a systemic basis, get the Australian stocks in the similar space to move up. But on a specific basis to which stocks we might be talking about, that's not something that I can cover off on, unfortunately, mate.
No worries at all.
Good question, though.
Thank you so much for your time, though. Thanks for joining us.
My pleasure. Have a good day.
Now, join us later this morning.